With many different structures of mutual funds available, sometimes confuses the investors as to which product should they invest in, suitable to their requirements. Two of such confusing structures are balanced advantage fund and multi-asset fund. Overview wise, both funds may look the same, but the sales pitch may sound different. Well, before delving into the question of the what product should select by whom, it is important to understand the strategies as per the SEBI guidelines. Both these products come under hybrid category of mutual funds. Balanced advantage fund is also called as dynamic asset allocation fund, where the composition of equity and debt is managed dynamically. As in, the fund can have 0 to 100% of equity and even 0 to 100% of debt. Now, as per the internal strategy of the fund house, these funds move between equity and debt. Some schemes follow an aggressive approach by having high equity exposure and all the time, and some prefer to keep rebalancing the asset allocation and provide the risk-adjusted return. And to manage the equity exposure, so to come under the equity taxation, these funds make use of derivative instruments. On the other side, multi-asset funds, as the name suggests, are required to invest in at least 3 asset classes with minimum of 10% exposure in each. So these funds are allocated into equity, debt, commodities like gold, silver. Some funds are also exposed to REITs and international equity to add more assets to it. Taxation wise, each scheme needs to be seen separately. Again, in this structure too, some prefer to remain high on equity and some have a mixed ratio of different asset classes. Now coming to the question, which fund is better to invest in? Well, that completely depends on the personal preferences, goals targeted, risk profile, the otherwise asset allocation in the total portfolio, and also the risk preference. Investment selection is never as simple as it looks to be. You select based on past returns which never show a clear picture. Both these funds categories are hybrid categories, which explains that these funds neither be as volatile nor high return generating as equity funds. The opposite is also true, that you cannot expect safety like debt schemes. If you are truly a long-term investor and follow a financial planning approach with a well-allocated and diversified portfolio, in my view, none of these schemes fit into your requirements. However, if you have a medium-term horizon, say for 3 to 5 years, and want to target a single goal, then you may consider such schemes. Question of which particular scheme to select is better to be discussed with your financial planner, because different fund houses comes with different flavors and returns cannot be the only criteria. Hope this helps.